Before we jump into today's episode on the Lenskart Solutions IPO, let me clarify my position. I am Zayd Haji, author, research student, and founder of Islamic Finance Research, Islamic Studies Research, and Inspire Guide Connect Islamic Guidance Council IGC Gate. But I am not an economist, policymaker, or legal expert. My views in this podcast represent a student's academic perspective based entirely on information available in the public domain. Every insight and opinion shared today is intended solely to encourage dialogue and promote critical thinking within the field of Islamic finance. Nothing here should be interpreted as investment advice, a policy recommendation, or a legal opinion. This podcast is meant for educational purposes only. It is never a substitute for competent financial counsel or professional investment guidance. The Islamic Finance Research podcast draws on published materials such as the Indian Government Budget Report, Indian Economic Survey, Reserve Bank of India publications, company annual reports from the National Stock Exchange and the Bombay Stock Exchange, as well as analytical platforms including Screener.in and Ticker Phonology. No part of our content constitutes stock tips or buy or sell recommendations. We are not registered with SEBI, and every episode is produced independently by students and researchers focused on advancing understanding in finance. When making personal or professional decisions, please consult a licensed advisor. Do not treat this podcast as your sole source for financial direction. If you and I were sitting here today, just the two of us, reviewing the story behind the Lenskart Solutions IPO, let us begin with what truly matters: how valuations create and sometimes distort the world that ordinary retail investors inhabit. Every valuation tells a story, but few reveal the hidden risks. Keep listening and I'll show you what most investors are blind to. We live in an era where valuation multiples like price to earnings, PE, and price to sales, PS, do not merely reflect growth expectations, they actively shape market sentiment. And sometimes that sentiment turns into speculation, breeding bubbles that can burst with devastating consequences. Think about it. Lenskart's IPO valued the company at roughly $8.5 billion based on 10 times its annual sales, while the entire Indian eyewear market itself is worth around $10 billion. It is almost as if the hopes, dreams, and future profits of an entire industry were compressed into a single listing. But the IPO game has never been about one moment of excitement. It is a well-rehearsed process with clearly defined winners and losers. The chain runs deep and efficiently. Private equity and venture capitalists enter early, push valuations higher through successive funding rounds, and then look for an exit when retail investors finally step in. It's a machine designed for profit extraction, not for fairness. Ask yourself, are you seeing through the hype or just following the crowd? Stay with me because the truth behind Lenskart's numbers will change how you think about investing forever. Let's be brutally honest. Many early investors made their fortune by selling at premium valuations. They benefited from the pump while average retail investors, lured in by media buzz and influencer optimism, often end up holding the bag once the hype fades and reality settles in. The Zayd Haji was the birth cautionary tale. Early backers, Safe Ventures, Elevation Capital, Alibaba, Ant Financial, and SoftBank walked away with staggering profits, while retail investors watched their investments shrink when market valuations corrected. For investors like us, those outside boardrooms, those not privy to insider briefings or early-stage term sheets, there are hard truths we must accept. The institutional machinery behind IPOs runs deep. Mutual funds and qualified institutional buyers, QIBs, play a critical role in book building, providing credibility and liquidity that allow early investors to exit smoothly. But here's the irony: your own systematic investment plans often fuel this very machinery. The money you dutifully invest every month may indirectly fund such IPOs, sustaining a cycle that inflates valuations further. And when the excitement fades, it's often the retail investor who absorbs the risk. Before you make your next move in the market, question everything you've been told. The reality of Lenskart's IPO isn't what it seems. Why does this matter? Because the lesson is crystal clear. Valuations matter. If you don't scrutinize earnings ratios or you rely solely on revenue multiples, you risk paying for hype instead of substance. A company trading at 200 times earnings might sound impressive, but the downside risk is embedded in that very number. Markets have a way of bringing inflated expectations back to reality, and when they do, retail portfolios suffer the most. And let's not pretend these risks are abstract or global, they are deeply local. India's IPO bubbles are built on domestic money, domestic optimism, and domestic portfolios. When these bubbles burst, the pain is felt not on Wall Street or in Singapore, but in Indian homes and small-town trading accounts. The most practical and empowering takeaway for us is this: financial literacy and skepticism are not luxuries, they are shields. Learn the basics of finance, understand valuation metrics, check fund holdings, diversify across asset classes, be deliberate, not impulsive. As responsible stewards of our own capital, we must align risk with reward, not chase flashy listing that promises overnight gains. Sometimes the wisest move is to stay with established, profit-driven businesses, be it global leaders like Nvidia or Amazon, or tangible assets like land and gold that retain real value through cycles. And here's a psychological rule worth remembering: never trust blindly. The system rewards those who question, analyze, verify, and demand evidence. Whether it's influencers, fund managers, or media pundits, every claim should be cross-checked, every ratio scrutinized, and every promise tested against performance. In modern markets, trust is not given, it's earned through consistency, transparency, and results. When we connect all these dots, the inflated valuations, the IPO mechanics, and the ground-level realities of financial markets, we arrive at one conclusion: to survive and thrive, we must evolve from mere participants into intelligent actors. The real message behind the Lenskart IPO is not about eyewear, it's about vision, financial vision, the ability to see through hype, understand mechanisms, and act with clarity when others follow the crowd. Because in markets, as in life, those who see through the bubble are the ones who last. And that is how we, as a generation of thoughtful investors, can reshape the game through vigilance, literacy, and critical thinking. If you and I were sitting together today, just two people trying to see the truth behind corporate glass, we'd talk not about eyewear, but about vision. Not the kind that helps you see clearer, but the kind that helps you see through. Because when it comes to Lenskart Solutions Limited, India's largest eyewear company, the real story is not what glossy PR campaigns, influencer ads, or billion-dollar valuations want you to believe. It's buried deep in annual reports, balance sheets, and financial disclosures, the kind of truth that never gets posted on Instagram. Most investors see the glamour, few see the danger. Stick around and I'll take you inside the numbers that media will never show. Let's start where it all began. Lenskart was born in 2008 under the name Value Technologies Private Limited. It wasn't a retail giant then, just a small startup selling glasses online. Fast forward to 2025, and it has become a corporate phenomenon, a tech-driven, vertically integrated eyewear empire with over 2,723 stores across 399 Indian cities and a presence in 143 cities globally. It designs, manufactures, brands, and retails everything in-house: frames, lenses, even the experience itself. From India to Japan, Singapore to Saudi Arabia, Lenskart's footprint stretches far beyond what anyone imagined. It sounds impressive, doesn't it? But as every investor knows, numbers tell stories that words can't hide. So let's dig into what the annual reports reveal, because numbers don't lie. Between 2022 and 2024, Lenskart was bleeding losses. The income statements were clear. Sales rose from 1,503 crore rupees in FY22 to 5,428 crore rupees in FY24, a healthy climb. Yet profits remain negative, with net losses of 102 crore rupees in 2022, 64 crore rupees in 2023, and 10 crore rupees in 2024. But then suddenly, almost magically, in 2025, the company reported a profit of 297 crore rupees on revenues of 6,653 crore rupees. After years of losses, this dramatic turnaround appeared just in time for their 7,278 crore rupee IPO. Coincidence? Maybe or maybe not. When you dig deeper into their financial statements, the balance sheet raises eyebrows. From borrowings of just 34 crore rupees in 2022, debt ballooned to 2,740 crore rupees by 2025. Meanwhile, equity capital jumped tenfold, from 15 crore to 154 crore in a single year. It looks less like organic growth and more like financial engineering, a pre-IPO cleanup operation. And here's the part no PR firm wants you to notice. The promoters hold only 17.57% of the company. That means over 80% is owned by venture capital funds, foreign institutions, and large investors. The real control lies not with the founders, but with FA's 59% and DII's 15%, the global funds and financial institutions that decide when to stay and when to sell. Now, pause for a second and think about that. When a company's founders own less than 1/5 of it, and the majority stake lies with those looking for exit opportunities, who do you think the IPO is really for? Are you ready to challenge what you thought you knew about growth, hype, and risk? Don't blink. What I reveal next could reshape your financial perspective. Let's connect the dots. From 2022 to 2025, Lenskart's expenses grew from 1,617 crore rupees to 5,675 crore rupees. Yet operating profit jumped from a loss of 115 crore rupees to a profit of 977 crore rupees. The operating margin swung from -8% to +15% in just 3 years. That's not evolution, that's a leap. Something extraordinary happened behind the scenes, and it wasn't just improved eyewear demand. Yes, the eyewear market in India is expanding, but Lenskart's valuation of $8.5 billion, around 71,000 crore rupees, is nearly equal to the entire Indian eyewear industry's size, which is about $10 billion. That means investors are betting that one company will own the future of an entire sector. Ambitious, certainly. Risky, absolutely. Their cash flow statements paint a story of rapid capital movement. Between FY21 and FY25, cash from operations jumped from a negative 117 crore rupees to a positive 1,231 crore rupees. Meanwhile, financing activities swung dramatically, suggesting heavy inflows from investors, followed by massive repayments, typical pre-IPO balance adjustments. So yes, the company is expanding manufacturing facilities in Bhiwadi and Gurugram, AI-driven design systems, and acquisitions like Ondays Japan. But the speed of transformation feels orchestrated, not organic. The question isn't whether Lenskart is a great brand, it clearly is. The question is whether its financial narrative matches its public story. The data suggests a different truth. Return on equity, ROE, barely touched 4% in 2025 while debt levels soared. Despite media hype about profits, fundamentals remain stretched. The price-to-earnings ratio sits at over 200, meaning investors are paying 200 rupees for every rupee the company earns. That's not investing, it's faith-based financing. And that brings us to the bigger picture, the IPO cycle. It's not designed for retail investors to win. Venture capitalists, early backers, and institutional funds buy early-scale valuations through hype and private rounds and exit when enthusiasm peaks. The 7,278 crore rupee IPO gave them liquidity. The ones entering now, ordinary investors, are the exit door for those leaving. Let's not forget the same playbook unfolded with Paytm, Zomato, and Nykaa. The early investors walked away rich. The public investors bore the correction. The system works like this. Private rounds inflate valuation. Media builds momentum. IPO provides retail enters at peak excitement. Reality corrects post-listing. And that's why you and I need to talk about literacy, not just liquidity. Valuations matter. Understanding them isn't for analysts alone, it's survival for investors. When a company's story sounds too perfect, the balance sheet will often whisper the truth. So what should you do? Stay alert. Read financials, not just headlines. Question, verify, analyze. Don't invest in narratives, invest in numbers. Look beyond marketing metrics like most trusted brand or most tech-savvy company. Those awards look good on brochures but do not move your portfolio. At the end of the day, Lenskart is both a marvel and a mirror. It reflects what's possible when vision meets innovation, but also what happens when valuations blur reality. The 2025 turnaround might be a success story or it might be a stage play perfectly timed before an IPO. And in markets, clarity is power. The truth is simple. Brands can sell you a pair of glasses, but only financial awareness can help you see. Let's talk about Lenskart Solutions Limited, not as a headline, not as a story spun for clicks, but as a living, breathing example of what happens when ambition meets capital markets and how numbers, not hype, tell the real story. Today, the stock trades at 421 rupees per share, giving the company a market capitalization of 73,073 crore rupees. At first glance, that number alone seems impressive, a sign of a company that has captured the imagination of investors. But when we peel back the layers, the deeper picture challenges our assumptions about growth, risk, and what it really means to be an investor in today's India. The first thing that hits you is the price-to-earnings ratio, 296. That is extraordinary. When the industry average hovers around 39, it raises the immediate question, what are we paying for? Every rupee of earnings is being valued at nearly 300 rupees in the market. As someone trying to make sense of this, I have to ask myself, and I ask you too, are we paying for current performance or the story of what might be? It is seductive, almost hypnotic, to see a company that claims technology-driven scale, omnichannel dominance, and international reach. But the truth is, high valuation multiples can mask reality. They can inflate perception, and if we are not careful, they can erode the very foundation of rational investing. Consider the profitability metrics. Earnings per share stand at 3.83 rupees, and the return on equity is 4.32%. Return on capital employed is just 5.577%, while the return on invested capital sits at 5.12%. These are not numbers that speak of efficiency or dominant returns. They speak of a company growing fast, yes, but with margins that remain thin, a business that is operationally stretched, and a financial structure that carries the weight of ambition. Then we have the debt. Lenskart carries 2,740 crore rupees in borrowings. For a company of its scale and market capitalization, that is a heavy load, a lever that can accelerate growth when markets are calm, but can magnify risk when conditions shift. And yet, the cash generated from operations tells a different story. 1,231 crore rupees. Here lies the paradox. On paper, operational cash flow is strong, but only just enough to service ambitions, investments, and the expectations of those who control the bulk of the shares. The enterprise value stands at 74,948 crore rupees, almost matching the market capitalization. The market is not just valuing what Lenskart has today, it is pricing in a future, a vision of dominance across India and Asia, a story of being the default choice for eyewear. Yet, when we consider the cash flow from the previous year, which was negative 71.8 crore rupees, we see a cautionary note. Growth is not linear. Success is not guaranteed. The balance between optimism and reality is fragile. What does all this teach us? That we as investors must look deeper than stock tickers and media praise. We must understand the real ratios that reveal operational efficiency, not just sales glamour. We must scrutinize ROCE and ROE and operational cash flows because these numbers will tell us whether the company is a powerhouse of sustainable growth or a high-flying story dependent on continued capital inflows and investor optimism. Finally, there is the psychological lesson. Lenskart, with its dazzling valuation, omnichannel presence, and technological reach, reminds us that narratives can seduce us faster than facts. The company has built an empire, yes, but the empire is not just bricks and glass. It is leverage, operational discipline, and a market willing to pay extraordinary multiples. And that is where you and I, as informed participants, need to pause, reflect, and decide, not based on hype, not based on what feels exciting, but based on the hard truths that the numbers whisper. Because understanding these ratios is not just an exercise in finance. It is a practice in critical thinking, in discipline, and in seeing beyond the spectacle. And for anyone serious about shaping their financial destiny, it is a lesson we cannot afford to ignore. From an Islamic finance perspective, the story of Lenskart Solutions Limited offers a rich case study on the intersection of business growth, market speculation, and ethical investing principles. Evaluating the company through the lens of Sharia-compliant finance, several insights emerge that demand careful reflection for both investors and researchers. Firstly, the financial trajectory of Lenskart reveals periods of consistent losses followed by a sudden surge in profitability in financial year 2025. From a net loss of 102 crore rupees in FY22 and 64 crore rupees in FY23 to a profit of 297 crore rupees in FY25, the turnaround coincides closely with its IPO listing, raising questions about the sustainability and underlying drivers of this profitability. For a Sharia-conscious investor, this pattern emphasizes the importance of ensuring that earnings are derived from genuine business activity rather than financial engineering, speculative hype, or excessive reliance on leverage. Secondly, the capital structure and ownership pattern warrant scrutiny. Promoters hold only 17.57% of the equity, while foreign institutional investors, FIs, control 59%, and domestic institutional investors, DIIs, 15%. In Islamic finance, excessive debt and reliance on interest-bearing borrowings are discouraged. Lenskart carries borrowings of 2,740 crore rupees against its market capitalization of 73,073 crore rupees, a level that, while manageable, indicates a high leverage environment and exposes the company to financial risks if cash flows are disrupted. Thirdly, the valuation multiples present an additional concern. A price-to-earnings ratio of 296 compared to an industry average of 39.2 signals that a large portion of the market price is based on expectation rather than realized profits. From a Sharia-compliant investment perspective, this exposes retail investors to gharar, excessive uncertainty, and may conflict with the principle of investing in assets with transparent, measurable economic activity. While Lenskart's operational cash flow of 1,231 crore rupees is strong, it is largely funded by capital inflows rather than sustained profit generation over multiple years. Finally, the company's operational model, vertically integrated, technology-driven, and focused on direct-to-consumer eyewear, is fundamentally sound and delivers tangible goods and services, which aligns with permissible business activity in Islamic finance. Its omnichannel strategy, international reach, and proprietary manufacturing facilities reflect a business grounded in real economic value creation. However, the combination of rapid expansion, heavy marketing expenses, and high valuation multiples indicates that investors must exercise caution and rely on rigorous due diligence rather than market sentiment. In conclusion, Lenskart presents a dual narrative. A company that has built a strong, tangible business with real economic activity, yet a stock priced in a way that exposes investors to excessive speculation and financial risk. From an Islamic finance perspective, this reinforces the timeless principles of risk-sharing, transparency, and the avoidance of gharar. Investors must differentiate between true business performance and market hype, ensuring that capital is deployed into ventures that generate halal income, are sustainable, and provide clear, measurable value to both shareholders and society. Thank you for joining me on this deep dive into the Lenskart Solutions IPO story, far beyond the polished headlines and marketing gloss, exploring the truth that company reports reveal and real numbers confirm. Remember, investing and understanding finance is not just about chasing trends or buzz. It is about grounding decisions in facts, critical thinking, and patience. If today's episode sparked your curiosity or challenged how you see the market, I encourage you to keep questioning, keep learning, and most importantly, keep demanding transparency from those whose stories shape our financial futures. For more insights and research on Islamic finance, entrepreneurship, and real market analysis, stay tuned and subscribe to the Islamic Finance Research Podcast. Until next time, I'm Zayd Haji, reminding you that true vision comes not only from what you see, but from the clarity with which you understand it. Keep your eyes open and your mind sharp.